Okay, so there's this tiny semiconductor company everyone's talking about, Navitas. They make power chips for AI data centers. They partnered with Nvidia. They're backed by the government through GlobalFoundries. All the AI hype machine is spinning around them. But here's the thing, and this is where most people miss the story. The company is also bleeding cash, diluting shareholders like crazy, and insiders are selling into the rally. Pretty wild, right? Let me walk you through what's actually happening inside this company. Navitas Semiconductor could be the next hidden AI infrastructure play. This tiny GaN chip maker just landed partnerships with Nvidia and GlobalFoundries, positioning itself as a US government-backed semiconductor champion. But most investors have no idea it exists, or worse, they only see the hype side. Here's where it gets weird. Everyone thinks Navitas is this underdog disruptor crushing it in the AI boom. That's the narrative. But then you dig into the SEC filings and you find something else entirely. A company burning through cash, printing shares like a central bank, and its own executives bailing out. Because the real story isn't about AI chips at all. It's about survival. Navitas was spun out of Stanford Research in 2014. They make GaN and CIC power semiconductor chips. Think of them as the translation layer between power sources and all your high-tech devices. Data centers, electric vehicle chargers, grid infrastructure. They're the plumbing for the energy transition and AI boom. That sounds great, and on paper it is. But the numbers tell a different story, the numbers that matter. Let's start with revenue. In 2024, they did $83 million in sales. Sounds solid. But 2025? They're on track for around $45 million. That's a 50% collapse. Q1 was $14 million. Q2 was $14.5 million. Q3 dropped to $10 million. Q4 is guiding to just $7 million. Here's where it gets interesting. This collapse isn't random. Management did this on purpose. They're abandoning the consumer phone charger business, low margin, flooded with competition, and pivoting to high-power AI in EV markets instead. It's strategic, but strategy doesn't pay bills. So how are they surviving? Cash raises. Lots of them. In November, Navitas did a $100 million private placement. They issued 14.8 million shares at $6.75 each. Cool. $100 million in the bank. Problem solved, right? Wrong. That's where you need to understand what's actually happening. Look at the share count. In November 2024, they had roughly 184 million shares outstanding. By November 2025, after all the raises, 230 million shares. That's a 24% increase in just 12 months. For existing shareholders, that means their ownership stake just got diluted by almost a quarter. The company's market cap would have to grow 24% just for the stock price to stay flat. But that's just the November raise. Before that, they were running an at-the-market program, basically a continuous drip feed of selling shares into the market whenever they needed cash. They authorized $50 million in March, exhausted it by May, then authorized another $50 million. That's the silent dilution machine most people don't see. And here's the kicker. That November PIPE deal came with a registration rights agreement. Within 2 weeks, the company filed to make those 14.8 million shares freely tradable on the open market. You know what that creates? A supply overhang. Smart money that bought in at $6.75 can now sell at $7.50 and lock in a risk-free profit. That's arbitrage. That's selling pressure. That's a ceiling on the stock price. Here's where it gets really interesting. In July 2025, news feeds lit up with a massive insider buy signal. The headline was that director Ranbir Singh bought 18.6 million shares, $163 million worth. Huge vote of confidence, right? Except it wasn't a buy. It was a reclassification. He moved shares from an LLC he owned to his personal name. No new money entered the company, no actual buying conviction. It was accounting. It was noise. But if you filter out that noise, what do you see? Actual selling. The CFO, Todd Glickman, sold 96,000 shares in November at $7.41, right before the PIPE announcement. Director Brian Long sold 500,000 shares in August, another 1.7 million in September. Over the trailing 12 months, net insider selling of 16.8 million shares versus almost nothing in buys. That's the signal. When CFOs are dumping stock right before capital raises, they're telling you something. They're saying, I prefer cash at this valuation over equity upside. That's not a bullish tell. Let's talk about their balance sheet. Total assets, $449 million. Sounds good, except $225 million of that is goodwill and intangible assets. That's 50% of everything they own is just accounting value. Phantom money from the gene-centric acquisition they did. Here's why that matters. If the pivot to AI and EV chips doesn't work, if gene-centric revenue doesn't materialize, the company will have to write that down. We're talking a massive impairment charge. A billion-dollar mistake on the books turns into tens of millions in charges. And we're already seeing warning signs. Revenue is plunging, EPS is missing targets, the company just reported material weaknesses in its financial controls. That's a red flag. It means their accounting processes aren't robust. It means they might have to hire external advisors and fix this, which costs money they don't have. Cash burn? About $25 million per quarter. They have $250 million on hand now after the raise. That sounds like a 10-quarter runway, right? But manufacturing ramps, which they need to do with GlobalFoundries, are insanely cash-intensive. If burn accelerates to $35 to $40 million quarterly, they're down to 18 months. And if the AI revenue doesn't show up, they're back to the capital raise treadmill. So here's what's really happening. Navitas has real technology. GaN and CIC chips are actually the future. The partnerships with Nvidia and GlobalFoundries are legitimately impressive. They're not fake, but the company is in what I call the valley of death. Old revenue is collapsing because they exited consumer. New revenue hasn't shown up yet because design wins in data centers take 18 to 24 months to convert to shipments. They're in the gap between two businesses, and they're burning cash to bridge it. The dilution? That's management saying, we don't think the equity market values us correctly, so we're using the stock as currency. Fine, that's fair, but it's a transfer of wealth from existing shareholders to new investors and employees with options. The short interest? It's massive. Between 20 and 30% of the float is short. And here's what's wild. It's not because short sellers are trapped. They're not. Days to cover is only 2 days. These are conviction shorts, hedge funds betting against the company because they see through the same red flags we're talking about. Is Navitas worth betting on? That depends on execution. If they actually crack the high-power GaN and CIC markets, if Nvidia design wins turn into volume, if GlobalFoundries delivery ramps, if they can survive the valley of death without raising more capital at even worse prices. Those are big ifs, and the stock is priced like they're all guaranteed to work out. Trading at roughly 28 times sales. For a company with negative earnings, that's bubble territory. You're not buying a company, you're buying a story. You're betting that the next 18 months of execution are flawless. Sometimes that bet works out, sometimes it doesn't. Navitas is a company with real technology and real partnerships operating within a capital structure that's increasingly hostile to shareholders. The dilution is real. The insider selling is real. The revenue collapse is real, but the AI opportunity is also real. This isn't a buy and forget stock. This is a trading vehicle. This is a spec play for people who understand the execution timeline and can afford to see it go to zero. The hype is loud, but the forensics tell a different story, and that's the part most people miss. So yeah, while everyone's chasing the big AI names like Nvidia, companies like Navitas exist in the shadows. They could be the next chapter of the AI infrastructure story, or they could be a cautionary tale about what happens when hype runs into physics, cash burns, and shareholder dilution. The next earnings, the next partnership announcement, the next capital raise, that's where you'll see if this story holds up. And hey, I hope this breakdown helps you on your quest for profits. Catch you on the next one.